Good afternoon and welcome to another Wealth of Advice market update on the 26th of March 2021. So it is almost a year to the exact day when the FTSE 100 bottomed below 5,000. I think 4,994 was the worst we saw as widespread fear over the pandemic engulfed world markets. So it wasn't just the UK FTSE 100 that had collapsed, every major stock market around the world had done the same. Dividend cuts were picking up speed. All companies issuing dividends reduced them massively. Oil prices had turned negative. Safe havens such as gold and the US dollar then started to perform strongly. 12 months later, the picture right now is very different, thankfully. We have seen more than the green shoots of recovery come through with regards markets. Virtually all of our client portfolios were back in profit towards the end of 2020, and every client who we're having reviews with right now are being shown annual reports showing a much more positive picture than it was previously. One of our clients sent us this article earlier on in the week, which maybe tongue-in-cheek. I don't know, I've not spoke with the columnist who wrote it, but he's saying that with everything going on in the world right now, there's no reason why the FTSE 100 can't get to 10,000. I'm not standing here this morning to say to you, this afternoon to say to you that we are going to see the FTSE shoot up by over 3,000 points in the next few months. But certainly it is a market that's dominated by mining stocks, oil companies, the sort of stocks which you are going to see do very well as we come out of this current lockdown period, and hopefully the world emerges from the quickest, hardest recession which it faced in over 100 years. This graph we're showing now shows the various asset classes and what they've returned over the last 12 months. And as you can see from that, if you were a person with a crystal ball or just the luckiest investor in the world, if you'd invested into global stocks and shares 12 months ago, you'd be up almost 50%. So those people who were able to invest right at the bottom of the market have seen some good growth since March of last year. The red bar on these graphs, and the next one coming up is from the same date, shows the actual growth since the 6th of November. The 6th of November being the date when it was announced that the vaccine rollout, well, the vaccines had all been given approval and there was going to be a rollout in the new year. And as you can see from there, global stocks and shares haven't massively outperformed everything else since November. As I say, commodities over that period of time has done well. High yield bonds have done okay since March, negative since November. And the two on the end there, and we did have a couple of clients querying this after our last update, corporate bonds and government bonds, which are regarded as the lowest risk asset classes. Because these are tradable investments and tradable asset classes, people can buy and sell them. There has been a sell-off in government bonds most recently, and their performance has turned negative. We believe that to be a short-term measure, and we're hoping that's going to change in the not too distant future. But again, this just re-emphasises the point about why we need to have a balanced approach in this, so much as having a multi-asset approach in your investments spread across a wide range of areas. This chart here looks at the total returns when we break down each sector. And as you can see, the place to be over the last 12 months, as we have mentioned on several occasions, has been those ones with the highest grey bars. But if you look at since November, the red bar there on the very left, energy returns have been phenomenal. So if you think back to the FTSE 100 graph, which is dominated by oil companies, energy is where the oil company sector is. That's doing well at the moment. So the portfolios that we have right now, we believe are well positioned for these growth spurts that we're seeing there. And the ones on the very right hand side of this graph is definitely the areas that we expect to do well in 2021 as well. Consumer staples, for example, you would hope to do well as we do emerge from lockdown and the world reopens again. There's been a lot in the press on the news channels recently about the UK's progress in issuing the vaccine. It's causing lots of concern to our European friends who are, I think, a little bit miffed the fact that we are so far ahead of them. We've got almost half of our population vaccinated now. That said, the UK's progress will slow in the coming weeks as supply issues will delay the first jabs, and priority is going to be given to giving people their second jabs on time. Europe, as I say, they're woefully behind where they are with giving out the vaccines, and that's leading to lockdowns going to happen across Europe. I was looking on the BBC's website this morning, and it was talking about what will a third wave look like in this country. And you look at that and you think, why are they sort of putting these stories out, which should really we should be reading the opposite stories. Yes, there might be an increase in infections because of the fact that there is a third wave coming from Europe. But if we've got all of our main categories of vulnerable people vaccinated by the summer, then it shouldn't really have that much of an impact on businesses and on companies. So I don't expect to see market falls happening in the next couple of months in the UK especially. Yes, Europe might be a tricky area, but as you can see from that graph on the left-hand side, the number of confirmed COVID cases all over the Europe and in the US has come down from the high points. Yes, in certain parts of Europe they're going back up, and that's because they aren't getting the vaccine rolled out. The UK has got to be commended for getting its vaccine rollout the way it has. In last year's presentations we talked about the US a lot. Obviously there was the lead up to the US election and what was going on there, what was Trump doing, how was that affecting the markets. Well, Biden's been quite quiet in a lot of respect. He hasn't had a press conference yet. It's unusual for an American president not to have done that yet. But what he's doing is saying he's getting on and fixing the problems and trying to avoid creating divisions. His first 100 days of his presidency, he wants to have 200 million Americans receiving the vaccine by then. And as you can see from that graph on the right-hand side there, although we've got almost, as I say, 40% of our population vaccinated so far, the US are starting to catch up. They've got millions and millions of doses in reserve now, and they really are ratcheting up their rollout. So if the US economy starts to reopen en masse from the summer, starts doing very well, you will see positive returns, because if the US funds do well, everything else seems to have a knock-on effect and do well also. So the UK and the US surging ahead is real good news, and we just want to see this continue. So although there is going to be this slowing progress in the UK in the next few weeks, I wouldn't let it really worry you too much. And as I said, the BBC and Sky News have got to issue these negative stories from time to time. If you think back to the Brexit saga, which was a 4-year news cycle really from 2016 when we voted for Brexit, think of all the crazy news stories you read over that time or so. Brexit's going to happen, we're not going to get any, they were talking about not us having any medication coming to our country, there was going to be food shortages, there was going to be all sorts of issues which never really arose. These graphs here are the positive ones. The number of people in hospitals in the UK is going down massively. We're getting more and more people vaccinated, and as I say, the summer and our lockdown coming to an end is not far away. The next area that we're going to look at is what the true state is of the labour market in the United Kingdom. As you can see from this graph here, if you go back to January 2019, the rate of unemployment, the true rate of unemployment, shall we say, was hovering just under 5%. So there has been lots in the press again, and lots of people who you will talk to will say unemployment's gone really high as a result of COVID. Well, it hasn't really. Yes, there has been an uptick, and you can see that from July 20 onwards. But the green lines there, which is the number of people who are currently still employed but are furloughed, obviously went through the roof, as you can see, as May, June went on, and Rishi Sunak first launched the furlough scheme. But then as the year went on, lots of businesses reduced the number of staff who were on furlough. Rishi Sunak extended the furlough scheme to the end of October. So you would expect, as the country emerges from lockdown, as all the restrictions come to an end, we can get normal shops open again in a few weeks' time and so on, that green bar will go down. The purple bar shows the number of people who are self-employed in this country. There's been no major change on that, I suspect. Yes, there will be people who are getting into difficulty, but overall we're doing okay. The overall rate of unemployment was around about 5.1% in December, and as I say, that's the figure that we want to sort of keep an eye on, and we would expect official unemployment to rise maybe above 6% is what some of the experts are telling us, but then as I say, as the economy reopens and businesses reopen, that should fall off again. So as I said at the beginning of the presentation, we are bang on a year from when the stock markets hit their worst point as a result of the collapse caused by the COVID crisis. We're now going to have a look at these graphs to show you sort of what markets have done over that period of time. Over the last 12 months, you can see that the S&P, which is the US stock market, from the actual bottom of the market is up 47%. The MSCI World Index is up 47% and the FTSE 100 up 38%. So yes, markets collapsed quite quickly as we know, but things recovered very, very quickly. And the graph that we were showing earlier with the bar chart with the different coloured performances from over a year and then from November is also further signified here. If we do look at the performance of those three indices from the end of November, you can clearly see that the FTSE 100, the UK market, is outperforming both the US and the World Index, which is very good to see, and we're going to hope that continues. Again, think back to the story of the FTSE 100 getting above 10,000. We've no idea where that FTSE 100 is going to be. The FTSE 100 is just a collective of 100 top stocks in the UK index. We should be more bothered about where the whole of UK PLC is going, how all of the companies in this country is going to do, as well as the rest of the world. But the UK being our home market where a lot of our portfolios are invested, we are quite positive as to how things are going, and hopefully that's going to continue. In the past, we have shown how portfolios have performed when we're looking at where the markets have gone from February the 18th last year up to now, that notional 100,000, how it fell. This graph here I think is good to see as well. We did have one or two very, very lucky clients who came to us at the end of March last year to invest new money into products, and I keep saying to people, we're not used car salesmen, we're just trying to flog products and great ideas, but those people who were lucky enough to get their money invested at the end of March last year, some of them are up over 30%. But as we keep saying, it's not time in the market, because those people who did that were lucky. It's time in the market, and the longer that you are invested in the stock market, in the funds, in the portfolios that we recommend, the better off you will be. In this part of the presentation, we're going to look at how growth and value stocks have performed over the last few months. For those clients who joined our webinar a few weeks ago, you may remember some of the fund managers explaining that the value stocks were now starting to outperform. Value stocks are those stocks or those shares in companies which are believed to be trading at a price lower than what their company is actually worth. So you do have more potential for growth because you're buying things at a discount. Growth stocks are those companies which are priced based on what people expect their future earnings to be. So last year, for example, when we spoke about how various markets were performing, and the US was really surging ahead, and it was those technology companies that were really surging ahead. They were growth stocks, which was based on their future earnings. And as you can see now from that red line going up, it's the value stocks that are starting to outperform now, and we're now back in a position where, as I say, you would hope that those unloved stocks are starting to surge ahead. So we're hoping that our fund managers who we've selected are making these appropriate changes. Wealth of Advice doesn't really have any sort of preference one way or the other. At this moment in time, we're just trusting these fund managers to make those changes accordingly. So that was the main part of today's presentation. As I say, clients do send us things from time to time, and this next chart that I'm about to show you is something which did amuse me when I saw it when it came across the other day, but I think it is very relevant for everyone. Although it's called One Way Road to Beer, and there's a website that's been created to show this, and I'd like to thank Alan James, the client who sent this across. So yes, it's a bit tongue-in-cheek explaining when we can all get back out and have a beer with our friends, but actually if you'd look at the days on there, it does show when certain parts of the economy is going to be reopening. We've got another 2 days before we can actually go to the park and have a beer with 5 friends, if that's what you would want to do. Obviously in the northeast of England, if this is where you're watching it, I'm sure the weather's a bit hit and miss to be sort of hanging your hat on being able to do that next week. But then in 16 days time, we will be able to go to a pub and have a beer in a beer garden. 51 days time, actually sit inside the pub and have a beer with 5 friends. And then 86 days time, that would be horrific if it was 86 weeks, but 86 days time, we can pretty much go out and do what we want, where we want. The pubs will be open, but also restaurants will be open. In 51 days' time is when all the shops and everything else is all sort of fully reopened. 16 days' time, we can all go and get a haircut again. As you can see, I shaved mine off again last week because it was starting to get out of hand again. I think a lot of people have took to that, or they are just sort of sprouting. But 16 days before that opens, so we are very close to the end of this. And as we bring it back sort of to look at sort of what our clients' investments have done and what they're likely to do in the future, I think once we get to that 86-day point and everything is reopened, the vaccine rollout continues to be really high. If you look at the main age groups that we've got vaccinated so far, then you've got to feel confident that we are going to come out with this in the summer, and then markets will continue to improve. So that wraps up another Wealth of Advice market update. Thanks for listening. As I say, it has been a long year since we hit that horrific point of the end of March last year when markets had collapsed. Thank you for all the clients who've persevered and stuck with the investments and listened to our advice over the last 12 months. As I say, everyone has been rewarded for staying in the market and seeing that funds and everything perform well thereafter. As usual, just close off by saying if anyone needs to see us for anything or get in touch, please don't hesitate to give us a call or send me an email. So thanks again and goodbye.